Imagine you're browsing real estate listings and you spot it. A beautiful Ohio home listed for exactly $300,000. It looks like a steal. Most buyers pull out their phones, punch that sticker price into a basic math app, factor in a rough interest rate, and assume they know their monthly budget. But lenders use a much stricter standard. This chart shows what the financial industry calls the 28-36 rule. It dictates that no more than 28% of your gross income should go toward housing, and your total combined debt shouldn't exceed 36%. Relying on incomplete top-level math is a direct path to violating that safety limit. Buyers sign a contract thinking they have room in their budget, only to realize later that they are drowning in hidden fees. To safely navigate the real estate market, you have to uncover a property's invisible costs, and that requires running your numbers through a localized Ohio mortgage calculator before you ever make an offer. Every mortgage calculation starts with the inescapable baseline, principal and interest. The principal is the actual cash you're borrowing to buy the home, and the interest is the fee you pay the bank for lending it to you. This balance scale demonstrates how your loan term alters that baseline. On one side, a 15-year term requires a high monthly payment block. But watch what happens when the scale tips to a 30-year term. The monthly block shrinks, but a massive pool of total interest rapidly expands beneath it. While it feels cheaper month to month, that extended timeline massively increases the total interest you eventually hand over. The type of loan you choose also dictates your future stability. A fixed-rate mortgage locks in your interest for the life of the loan. An adjustable-rate mortgage, or ARM, often starts cheaper, but allows the interest rate to shift with the market, transferring the risk of future payment spikes directly onto your shoulders. Locking down your principal, interest, and loan terms gives you a solid foundation, but those numbers only represent about half of your actual monthly bill. This is where generic, national calculators fail. They rely on national averages. In reality, property taxes are highly localized, and they heavily dictate your final monthly budget. Look at this side-by-side comparison of two identically priced homes. The property on the left in Franklin County carries an estimated 1.65% tax rate, creating a moderate monthly cost bar. The exact same home in Cuyahoga County hits a 1.77% rate, driving that monthly cost bar noticeably higher. While a 0.12% difference sounds microscopic, over a 30-year loan on a $300,000 property, it compounds into thousands of dollars of extra financial burden. Then there are the state-specific transactional costs waiting for you at the closing table. Ohio counties frequently charge a conveyance fee, often around 0.4% of the purchase price, alongside mandatory county recording fees. Geography dictates affordability. Exactly where you buy in Ohio invisibly but drastically alters what you can actually afford to purchase. Next, we have to layer on the recurring costs required to protect the property itself. Lenders mandate homeowners insurance to cover damage, and if you buy into a managed community, you will also pay monthly homeowner association fees. And if you don't have enough upfront cash, you'll encounter private mortgage insurance, or PMI. This is an extra monthly penalty fee imposed by the lender if your down payment is less than 20% of the home's purchase price. This stacked bar chart tracks a total monthly payment. Watch the slider at the bottom. As the down payment increases to exactly 20%, the thick red PMI block vanishes, shrinking the monthly bill. Stripping away that penalty frees up hundreds of dollars every month, which a smart buyer can aggressively redirect straight toward their principal balance, shortening the loan. Proactively testing these variables in an Ohio-specific calculator is the only effective method to shield yourself from expensive, budget-breaking surprises before closing day. When we fully stack the principal, interest, localized property taxes, insurance, and potential PMI, we finally arrive at the true monthly total. This accurate, comprehensive figure is often vastly higher than the dangerously low napkin math estimate most buyers start with. This fully loaded number serves as your personal financial stress test. You take this total and check it against your gross income to guarantee you are staying safely with the 28-36 rule we established earlier. Do not attend a showing, fall in love with a property, or sign an official offer without running your specific local numbers first. Identifying these localized costs ahead of time allows you to build a budget based on data rather than assumptions, reducing the risk of expensive surprises after you move in.